Tax reform. It was one of the hallmarks of his campaign, and now 8 months into his presidency, President Trump has taken the wraps off a tax reform proposal that calls for sweeping tax cuts and a simplification of the very complicated tax code.
There's never been tax cuts like what we're talking about.
President Trump unveiling a 9-page framework that includes reducing the number of tax brackets from 7 to 3, doubling the standard deduction, increasing the child tax credit, reducing the corporate tax rate from 35 to 20%, creating a new tax rate for pass-through businesses, and eliminating the alternative minimum tax and estate tax. Trump's plan lacks many details, including what the income levels are for new tax brackets and how he plans to pay for the tax cuts. The Committee for a Responsible Federal Budget estimates they will add $2.2 trillion to the deficit.
This is a revolutionary change, and the biggest winners will be the everyday American workers.
That's President Trump attempting to cast his proposal as a boon for the middle class. But is it? To help us sort out some of the questions, I'm pleased to be joined by CPA Marty Davidoff, who for 30 years has specialized in tax issues and problems with the IRS. He's the founder of the Davidoff and Associates in Dayton, New Jersey. Welcome.
Thank you very much.
Very complicated issue. So the first question is the president correct? Will this be a boon for the middle class?
I don't believe it will be. It may be some savings for some of the middle class, but we'll have to see when a lot of the details come out. They haven't, for example, said where the tax rates will hit.
Now, the Democrats have already chimed in, and they have opposition. They say the wealthy will be the real beneficiaries of this. Is that correct?
I think the wealthy will get a disproportionate share of the benefits. There are a couple of things like reducing the flow-throughs from 35 to 25%. That would be a big benefit for the wealthy. Reducing the corporate rate may be a benefit for all people if the economy really gets a boom. Right now, internationally, you have where the highest tax rate at 35%, where the average for industrialized nation is at 22.5%. So reducing down to 20% will make us more competitive worldwide.
How will the average American, the middle class, how will they be impacted by
the middle class? For many of the middle class, especially the lower middle class, they will be much simpler. They will have a higher standard deduction. They'll be able to not have to fret as to who gets the exemption for divorced couples, who gets the exemption, the ex-husband or the ex-wife. That will no longer be an issue because there will be no dependency exemptions. They'll just be able to get their standard deduction for married couples up to $24,000. So they get a benefit of that. But a lot of the middle class, particularly in New York, they're saying that they're going to lose the state and local income tax deduction. That's what the plan that the president's come out with. However, Congress, even as early as this morning, a lot of the congressional delegations are saying, no, we're not going to go for that. So something's going to give.
Well, the alternative minimum tax, originally put into effect to help the middle class, but has been more of a burden over the years, that would be eliminated. Is that's a benefit?
I think that's one of the best benefits because it's very complicated. It hits people. It actually hits the rich more than the very rich, and I think the elimination of that will be very helpful.
Okay, let's talk about the elimination of tax brackets from 7 to 3. What do we know about that? How will they judge the income levels, and a lot of questions surrounding
it? A lot of questions, but some things that are out there. So right now we have rates going from 10% to 39.6%, and they're going to have 3 rates, 12, 25, and 35%. But there's a provision in the law that says we may also add another higher rate, and I think that's going to be their escape clause. They're going to say, well, we're going to have this higher rate for maybe the very rich. Right now, the 39.6% only hits people who are $400,000 or more. What they may do is they may come back when they see that they're not raising enough revenue and say, okay, we're going to add that fourth tax rate at 39 or 40% for maybe over $1 million or $1.5 million. But there is specifically in the provision and the very short summary say we may add a fourth tax rate. So everybody's talking about the 35% as the top tax rate, but that's not what the document says. What they call the framework that the top 6 people came from Congress and the Treasury and the President, that framework specifically says we may have another tax rate, and I think that may be the way that they get the Democrats on board.
Now, what about the basic standard deduction? That's going to be doubled, so that'll be another benefit.
It'll be doubled, but you're going to have to give up your personal exemption. So a family with 3 or more children will actually be worse off because they're going to not have their $4,000 per year exemption for each person, but smaller families. Now, the president says that, well, we're going to have an increase in the child care credit, but they don't tell us what the increase is. So that may balance it all out. But it will simplify things, because a lot of people who had itemized deductions between $12,000 and $24,000 won't need to itemize anymore. They'll take the standard deduction.
But something that many people were concerned about retirement and college deductions, that will remain the same.
That's correct. That's absolutely correct.
What about, I know there were a lot of people who were fearful, me included, about elimination of the deduction for mortgages, but that's not going to be touched. That's going to be...
They said that they would protect the mortgage interest deduction. However, in previous versions, they talked about reducing the deduction for homes up to $1 million to homes up to $500,000. That's not in the current framework, but that might be something they bring back in if they give up, for example, the state and local income tax deduction.
Now, the word simplification, it seems to be incongruous when we're talking about this tax reform package. Now, what is not addressed in this simplification?
Well, there are a couple of things that are not addressed. First of all, we have so many different retirement plan and pension alternatives. You don't need that many. You need maybe two, a 401k type plan and a Roth type plan, and that's it. You don't have that complication. The other thing is, right now, gambling is very complicated. Gambling is becoming more and more popular. There are more gambling locations. You have to report your gambling winnings on the front of your return, and you only get to report your gambling deductions if you itemize your deductions. So that if they raise the standard deduction, the little old lady who's going to Atlantic City will have to pick up her winnings, but not her losses. And determining what your winnings and losses are, what a session is very complicated. They should eliminate that. Finally, they should allow all deductions for producing income. They're actually going to add some complication, as I call it, complication, when they try to simplify. They're going to add some complication by limiting certain deductions for interest by businesses, and already we're not allowed to deduct half of our meals and entertainment and other things.
Anything that we could do now before the end of the year to prepare for this? This is going to take some time before it gets through Congress, and it's going to go through many modifications, no doubt. Anything we should be doing now?
Well, first of all, keep an eye on the law. We can pretty much assume that there'll be a January 1, 2018 effective date, except for the new investment in assets. There's a new provision that will help businesses. The new investment in assets, to deduct them, will take place as of now. But a couple of things that you can do. You can accelerate your business deductions into 17, because most likely your tax rates will be lower in 2018. You can take your itemized deductions in 17 rather than 18, because in 18 you may not have itemized deductions, again, and the rate is higher. Just be careful in 17, if you accelerate state and local income taxes, you may run into the AMT. So go to your CPA and run the numbers.
All right, the big question is, that all sounds pretty good, I guess, but how are they going to pay for this? It's estimated it will contribute to a $2.2 trillion, that's with a T, $trillion deficit. How's the government going to pay for these tax cuts?
Well, they're not going to pay for it. That's why it's not going to be passed as it is here. But there are some provisions to bring in more revenue. The state eliminating the state and local income taxes is one. Some corporate tax reform, some shelters. But I think what they're going to do, they have what is called dynamic scoring. They're going to say, well, if we do this, we're going to have more money in the economy and more taxes. They may get some of it that way, but in essence, they're not going to pay for it. And things like the elimination of the estate tax probably won't happen, because it's giving up $270 billion.
Do you see this for the economy as a pro-growth agenda that he's put forth here?
I do see it as a pro-growth agenda. But
for jobs?
I believe it's a pro-growth agenda. I don't know if it's going to be, but what it may do is it may cut the budget so much that you're not in a position to have those social programs that are also necessary.
So, Marty, what's your final evaluation as a CPA who has dealt with tax matters and battled with the IRS over the years? What's your evaluation of what you heard from the president the other day?
My evaluation is that he's not being really truthful with the United States on this, but there are some simplifications here that are important, and I think we should hope that Congress focuses on those.
So there are still many unanswered questions, and rest assured we're going to hear a lot about this. What would you guess? Maybe a year before something like that?
No, I think by year end you're going to see something. I think by year end you're going to see some legislation, because if they get into an election year next year, I don't think anything's going to happen. I think you're going to see it by year end.
Marty Davidoff of Davidoff & Associates in Dayton, New Jersey, thank you so much.
Thank you.
For your tax advice.
You're very welcome.
The bill's in the mail. All right, we're going to take a break. We come back. We'll talk about Pulaski and tribute to Polish Americans. We'll be right back.